You hear the phrase everywhere, just buy the S&P 500. Financial news talks about it daily, and billionaire investors mention it all the time. But if you're new to investing, the term can feel like confusing financial jargon. So in the next 5 minutes, we're going to break down exactly what the S&P 500 is, how it works, and why millions of investors use it as the foundation of their portfolios. Let's start with the basics. The S&P 500 is not a company, and it's not something you can physically buy by itself. It's an index. Think of an index as a scoreboard for the stock market. The S&P 500 tracks the performance of 500 of the largest publicly traded companies in the United States. When you hear someone say, "the market is up today," they're usually referring to this index. It includes companies across almost every major industry: technology, healthcare, banking, retail, energy, and more. Because it tracks so many large companies, the S&P 500 is often used as a quick snapshot of how the US stock market is performing overall. But how does this index actually calculate its value? The S&P 500 uses something called market capitalization weighting. In simple terms, that means bigger companies have more influence on the index than smaller ones. Think about it like a class grade. Your final exam might count for 40% of your grade, while a small homework assignment might only count for 2%. The S&P 500 works the same way. Massive companies worth trillions of dollars have a much bigger impact on the index, while smaller companies on the list affect it much less. Now, here's an important point. Because the S&P 500 is just a mathematical index, you can't buy it directly. Instead, investors buy index funds or ETFs that track the S&P 500. These funds hold shares of all 500 companies in the same proportions as the index. And this is where the real advantage comes in. When you buy a single share of an S&P 500 index fund, you instantly own a tiny piece of 500 major companies at the same time. That means immediate diversification. Instead of betting on one company succeeding, you're investing in the overall growth of the largest businesses in the United States. Another powerful feature is that the index updates itself automatically. If a company becomes smaller or declines over time, it may eventually be removed from the index and replaced by a stronger company. So, the S&P 500 is constantly evolving to reflect the largest and most influential businesses in the economy. But like any investment, it's important to understand the risks. The S&P 500 is still tied to the stock market, which means it can be volatile in the short term. In some years, the index can drop 20% or more due to recessions, global events, or economic uncertainty. That's why the S&P 500 is generally considered a long-term investment, not something meant for money you'll need next year. There's also another limitation. Even though many companies in the index operate globally, they are still US-based companies. If the American economy struggles for a long period of time, that will affect the index. To see how this works over time, let's look at a simple example. Imagine someone investing $350 per month into an S&P 500 index fund starting at age 28. If the market averages about 8% per year, after 14 years they would have invested around $58,800 of their own money. But thanks to long-term market growth, the portfolio could grow to roughly $109,000. That difference comes from compound growth, where your investments start generating returns on top of previous returns. However, the biggest factor in success with the S&P 500 is behavior. One of the most common mistakes beginners make is trying to treat the index like a short-term trading tool, buying when the news is positive and selling when markets fall. But the S&P 500 was never designed for short-term timing. It's built for long periods of consistent investing. Another mistake is obsessively watching the market every day. Checking the price constantly can create unnecessary stress and often leads investors to make emotional decisions. The S&P 500 works best when it's treated as a long-term engine for growth, not a daily scoreboard. Ultimately, the S&P 500 is simply a diversified portfolio of the largest companies in America. It removes the need to pick individual stock winners and instead allows investors to capture the broader growth of businesses and innovation over time. And for many investors, that simple approach has been one of the most reliable ways to build wealth.